Hey traders, welcome to Top Tier Outlook. Happy Sunday, everybody. We're taking a look at the week ahead, the week of November 11th. And we've got a lot behind us now. We've got the election behind us. We've got the November FOMC meeting behind us. We got that quarter point cut. We're still probabilistically looking at another cut in December, but that's going to be an interesting one. So let's start there. Let's start with a macro look at what's happening. And we'll start with the FOMC. We have another meeting in 37 days, and we're looking at that December 18 meeting. And there it is. So here's December 18. And what are we expecting? It's actually a little less likely of a cut by about 5% than it was even just last week. So we're still about 65% expecting a quarter point cut from the Federal Reserve. And by the way, the first time we start to lose that overwhelming discounting, that overwhelming clarity for the rate cut, every near-term meeting, whether that be January, March, or even May, starts to get very, very unclear because there's still that question mark hanging over whether or not the Federal Reserve holds or cuts in 37 days. So we've got at least at this point in the year, 3/4 of a point worth of cuts. The half point cut in September, now the quarter point cut in November, and we rounded out to 1 full percentage point, 100 basis points as we wrap up the year. It may not really matter a lot. So let's talk about what are some of the other forces aside from the macroeconomics that could keep this rally going. And I don't mean just the election, day after election result rally on Wednesday, but in general, what are some of the other things that we're going to keep an eye on as we go into the end of the year? And one of the factors that'll become more and more influential is the expectation of window dressing. So for as much as a lot of folks will say there's no such thing as window dressing, we don't see portfolios padded with the outperformers come the end of the year. I think we all know better, don't we? Of course, we're going to see, and I'm not saying it's an insidious thing. If at the end of the year, that's the report card, right? That's the point at which if you're managing money for other people and you've got to present to them at the end of the year, this is what you've got going into 2025. And if the equity markets are rallying, or let's say technology is rallying, or semiconductors or financials, whatever it is, or a particular stock like Tesla, folks who have their money managed are going to ask their money manager and say, do I have fill in the blank, whatever outperforming stock? Remember, recency bias is so important to understand in terms of why traders focus on things and give so much more weight to things that have happened recently. A recency bias is huge. Let me do something here real quick. I'm going to make this chart fill up this screen a little bit better. There we go. Okay, so this is what's been happening in Tesla. And if it continues to rally, do you think that someone who's letting someone else manage your money, and when they take a look at what their holdings are at the end of the year, if Tesla's not amongst them, do you think they're going to be a little upset? Well, the opposite thing happens as well. Let's say you take a look at an underperformer, and a pretty good underperformer, but a big name would be Microsoft. You take a look at Microsoft within the context. Now, take a look at this. You might say, Rog, it doesn't look that bad. It's chop. It looks awful when you just consider that the NASDAQ put in a new all-time high, right? That's relative performance. And that's where you start to think about, on the flip side of window dressing, is dumping underperformers. Both things are going to happen. And it definitely is, at the end of the year, going to selectively benefit certain stocks, certain sectors that are in terms of the recency bias, what's been happening in Q4, you're going to see a lot of those names start to benefit. So let's say we look at quarter to date. This might be a really interesting thing to look at as we go into the end of the year. What has been a relative outperformer so far this quarter, keeping in mind the recency bias? And the thing that we want to keep in mind is that metals and mining, financials, consumer discretionary, energy. Some of these names have really seen a very strong surge in Q3. In some cases, just as of last week, as we got the clarity on the election, some of these things we're going to keep an eye on as we go into the end of November and into December. So these aren't decisions I'm saying we're going to make now. This is watch list building. And if watch list building 101 is find the names that preferably have trends or have relative outperformance, it really should be or I want right? I want relative performance and I want a trend. And if that can persist, we'll just buy dips. It works. But you've got to find the symbols that are valid for a buy the dip. A lot of times buy the dip gets mocked a lot because a lot of times what happens is people use that strategy in a stock that doesn't have the probability of following through. I mean, it's not as if some symbols don't have merit of their own with certain strategies, but it's a lot like showing up at the golf course with a tennis racket. Perfectly fine thing, wrong sport, right? So I think a lot of times we kind of take our favorite club everywhere we go, right? Or take our favorite sport everywhere we go. And so if we can start to say, well, if I like momentum breakouts, for example, which by the way, I don't, there are certain structures that favor momentum breakouts. If you like buy the dip, which is what I talk about 99% of the time, there is a certain structure. There's a certain formatting. There's a certain alignment that favors that strategy. So if we can have the strategy fit the symbol, fit the behavior, then we're in really good shape. All right, so those are two things. And I haven't talked a lot about quarter to date quite yet. We're about halfway through the quarter, so it starts to make sense to talk about quarter to date and window dressing as we go into basically the last roughly month and a half of the year. Unbelievable. 2024 is almost in the books. All right, so what do we have as we go into 2024? Well, we're going to have all-time highs in the S&P, in the NASDAQ. What about the Dow? All right, the Dow finally punched up to a higher high. And there are two sectors that we have to keep very close eye on. The Dow's weighting is not like the NASDAQ, and the NASDAQ's not like the S&P, although they're very similar. The main thing we want to keep an eye on when it comes to the Dow is that the two sectors that have been problematic for the Dow, where it's not been keeping pace with the NASDAQ and the S&P, is energy and healthcare have really been laggards. So if the Dow's going to start to keep pace with the other two, we need to see at least one, if not both of these, start to make some gains to the upside. So rather than being weighted down by those two sectors, it can start to benefit from what already is strong within it. Things like financials, things like transports, things like technology, which are weighted in the Dow, but without the participation of healthcare and or energy. Both would be great. One is really necessary. The Dow might be a little laggy. But right now, and finally, the Dow's starting to keep pace. Financials have been strong. Industrials have been strong. Transports have been strong. And that's going to be at least enough for now. All three of the indices have just punched up to brand new highs. And as it said, new highs are never bearish. This is not the time to say, well, it's gone too high. In the context of an uptrend, there's no such thing. And rarely does it make sense to look at something as important as an all-time high and say, well, this is the high and I want to short into this. Do that if you hate your money. But I'll say Wall Street is definitely not a charity. There are charitable organizations that will take your dollars. You don't need to make that donation to Wall Street. All right. So what else are we keeping an eye on here? Bonds. All right. Are we finally starting to see a bottoming pattern maybe in bonds? Way too soon to tell. I'm not going to guess. I don't get rewarded probabilistically for guessing. So I'm going to move on to where there's a little bit more clarity. More clarity is in gold. Maybe a little bit more clarity, possibly in the euro and in the US dollar, right? I want to see that euro start to go back into a chop. I want to see this euro back above the 109 handle, but that might be too soon to tell as well. So there are certain symbols that I have interest in from the perspective of their importance macroeconomically, but from the structure of their chart, when I look at it, I don't see that I have an edge. What's an edge? It's a repeating it's a repeating circumstance. It could be a pattern, it could be volatility, it could be volume. Preferably, it's a mix of all of that. But it's a repeating circumstance that I know when I see that it will work more often than not. And I just don't have that right now. So it's not as if we're lacking things to trade. So let's go ahead and take a look at what we've got going on in financials. I mentioned this outperforming corner of the market. It certainly is. I tried to get into financials on Thursday with the Federal Reserve, and I just did not get my fill. We did get a piece of the IYT. We do have a couple positions. I'd like to have a little bit more. I was a little, straight up, I was a little disappointed in the lack of volatility from the Federal Reserve meeting. It was a little disappointing that oftentimes at the end of the press conference, so we get the rate statement at 2 p.m. Eastern, 30 minutes later, Jerome shows up at the podium and he gets peppered with questions. And usually at the end of that press conference, when he mic drops, a lot of times the equity markets just sell off. It's almost like they stay buoyed while he's speaking and then whoosh, it's just gone. The support is gone at the end of the meeting and at the end of the conference. And that's just not what happened. So I was kind of disappointed because, again, I was playing a probabilistic circumstance and it did sell off a little bit, just not as much as I would have liked. And so I got one of the two things that I wanted to get filled on. And that's okay. That's totally okay. We're going to have plenty more opportunities. In fact, if we take a look at the economic calendar, let's go see, well, Rob, if we didn't get the volatility that we wanted on Thursday, what could be that next window for volatility that might give us that pullback, and that ultimately might give us some of these fills in those trending sectors and those trending stocks. Tomorrow's session is going to be a quirky day, mainly because the banks are closed observing Veterans Day. And, it's one of those times when the markets really should be closed. It's Veterans Day. This should really be a market that's closed. But the banks are closed, which means bonds are closed. And ultimately, what I want to do is focus on where the follow-through could be maybe on Tuesday. We might have some decent movement, but I'm going to look at tomorrow as lower participation, right? We don't have as much volume. We don't have as much attention. And without that, I'm really not expecting a lot of big decisions to be made on Monday. However, that shortens the week and brings us to Tuesday. So take a peek. On Tuesday, we start to get a number of FOMC speakers, lots of them, starting to happen. We have 5 alone on Tuesday. Now, granted, 2 of them are happening after the close, but there's plenty to start to see. We have the CPI on Wednesday, more FOMC members. My gosh, 3 of them on Wednesday. And then we go into Thursday, more FOMC speak. PPI numbers, again, more FOMC speak. Then we have Chair Powell speaking at a panel discussion. So Thursday could be interesting. So what quiet action we might get on Monday, we're going to have a lot more action Tuesday, Wednesday, Thursday by way of data and FOMC. So clearly when it comes to catalysts that could create those pullbacks for our trades, that's the way we want to look at it. And then Friday, we have a biggie, core retail sales. So for as much as the previous, say, 10 months, the consumer, whether they were buying a home, whether they were, sentiment was good or bad, retail sales, those weren't as important as employment and inflation numbers. Now that the rate cuts have begun, inflation numbers haven't been as influential. And what's taken that over? What the consumer is doing. Do they have a job? Are they spending money? Are they buying a home? And what's their sentiment? And really a lot of that is what now has been very influential. Of course, still employment, but really it's much more about the consumer now, their employment, their spending habits, etc. And that's going to be a big hot zone this week on Friday. All right, so let's go back to the broader averages. So I mentioned the S&P all-time highs. We have many of the cylinders of this motor, financials, tech, moving higher. Healthcare is a cylinder, is a sector, right? You want to think of it as a motor in the S&P. But because tech has been so darn strong as of late, you're seeing that even that laggy healthcare isn't even holding the Dow back, right? And so what's happening is financials, tech, industrials, transports are moving these higher. When you take a look at the Russell, you can see the all-time highs here. The main sector to keep an eye on is the KRE. And remember what we said early on in this discussion. If there's going to be any kind of inkling of window dressing, where if someone's managing money, they're going to say, look, what is my client going to want to see in their portfolio come end of year? Most folks aren't, sadly, as savvy to know their cost basis. They just want to know, do they have that stock in their portfolio or not? Cost basis is another level. But if I look at, again, quarter to date, what are those sectors that, again, with recency bias at the helm of psychology, anything in that top 5, top 6, really probably anything positive this year, it's going to have a little bit more chance of that window dressing, meaning that buying going into the end of the year. Right now, what's lagging is home construction, staples, healthcare, gold miners, basic materials, utilities, real estate. Those are lagging. So keep this in mind too. If something's lagging, a lot of times they're going to be discarded from portfolios. So as much as we have strength getting stronger, there's also the possibility of weakness getting weaker, right? So keep that in mind. All right. So let's see here. Sean asked, do I have a target for IWM by end of year? Sean, I don't know who would in their right mind answer that question for you, my friend, and I appreciate the question. Nobody knows where something is going to go. So I get these questions from time to time, and it kills me that traders think this is trading. And I'm not, by no means, Sean, calling you out on this. I mean, it's a common kind of question. Rog, what do you think over the next week? What do you think over the next month? What I had someone ask me what was going to happen next year, and I'm thinking, does anyone really think that trading is about prediction? And does anyone really think that anyone knows where a stock is ultimately going? All we know is that it could keep going higher, it could keep going lower. Where it stops, how it pulls back, the journey there, gang, that's trading. We have to normalize the idea that nobody knows what's going to happen, but it's our job to ask what criteria on the chart, if it happens on a 5-minute, 1 hour, daily chart time frame, weekly time frame, whatever that criteria is, can I manage risk from that level? And could I see follow through from there? That's it. That's it. So anything that starts to wrap into prediction, if anybody answers that, the level of arrogance, I'm just not going to go there, right? The level of, yes, this is what's going to happen is ludicrous. All I can tell you right now about anything related to the Russell is watch regional banks. That's a very influential sector. And gang, I appreciate the question. The problem is people on television do this nonsense all day, every day. They sit around talking targets. The brokerages do it. They sit around talking targets. That is not our job. A target is not a trade. How do we get to the target? How much unrealized risk are we going to take to get there? What is the entry? What is the stop loss? What is the first scale out? That's trading, right? I'll leave it to the geniuses that can see the future. They're all on television. Clearly, they all have the same crystal ball. I don't honestly know, my friend, but it's more than that. Nobody does. However, here's what I can tell you. All right, let's get tactical. Let me leave you with at least maybe something you can work with. Okay, there is for me 2 tools that I'll look at really closely. One is, let me get my drawing tools out here. And gang, I really want you all to get this. And I really want this programming of talking about targets. Where's something going to go? You know, that would be like today, somebody asking me what teams are going to be in the playoffs. If I were on November 10th, right, saying, hey, at the end of the year, we're going to have a pretty good playoff picture by then, right? Could I reasonably tell any one of you who's going to be in the playoffs? We could guess, right? We could look at some records and guess, but who is going to say, yeah, Rob, these are the teams that are going to be in the playoffs, right? Or even worse, here are the scores, right? Here are the scores. Please think about it in the context outside of the market. And if anybody talks targets with that kind of confidence, that's what they're telling you. They're telling you that they know who's going to be in the playoffs end of December, That's not that far away, right? Oh, I'll tell you who's going to be in the playoffs, and I'll even tell you the score. That's what market people do on television and in financial media all the time. And if I did that in sports, if I did it in football, you'd say, Rog, you're just guessing. Guess what? So are they. Right? All right. So what I can say is this is support, right? Just like this was support the day before and this was support the day before. If in the context of a trend, I pull back to a volatility, historical volatility zone, my expectations are the trend will continue. That's it, right? That's it. And then I ask myself, what are the obstacles along the way? I'm a trader, gang. And I'm imagining most of you are too. So the most important thing we got to ask ourselves is, Rog, when you're in a trade, how long might you be in the trade for? On a 1 day time frame, 2 to 10 days. 2 to 10 days, right? I might be in some of these trades maybe by options expiration, maybe by the end of the month, if I can push out maybe 21 days. But for the most part, I'm going to have to deal with OpEx, and a lot of times I'll be flat, right? That's ultimately, think about how long could you be in the trade, right? So if my goal is to figure out how I can get in and get out and make some profit, knowing that the follow through could last 2 to 10 days, it may not even last up to 10. That's my job. Where do I get in? How do I manage risk? What's the first target? And maybe what's the second? And somehow or other, trading is getting very, very far away from that. And I really don't know why, but I do know it's not helping traders, right? I do know that. And here's how I know, and here's how I can tell you what I'm in, right? At the end of the day, unless someone's willing to say, Rob, these are all the positions we have, and these are all the levels at which we bought them. I don't mean, percentages. That's garbage, right? Especially folks who add 4 and 5 times, lower the cost basis and say, well, this is what we made, right? That's not trading either. So what we need every day, if we're going to learn how to do this, is every single day we need to know what are we in and what are every single entry prices listed in a single line. And then what is every single scale out. And then ultimately everyone can see, okay, Rog, I can see you bought Cisco. You had a 210 entry. Okay, so far you scaled out at 250 and at $3.20. That's dollars. That's where the conversation has to be. And the conversation's turning into this whole thing of, we made 50%, we made 100%. 100% of what? 100% of what? Right? Because buying something for 1 cent and it going to 2 cents is 100%. Buying something for 15 cents and going to 30 cents, that's 100%. Right? So this is why we talk price, right? Where do we get in? Where do we get out? Every day, including losses, right? Including losses. And that's really where we have to be. Now, if someone were to ask me, is there a probability that the Russell could continue higher? Yeah, I would continue to focus, especially on KRE. I would continue to focus on pullback buys in the Russell, near-term highs to scale out. That would be my first target. And then I can see how high is high. Right now, I'm also shifting to the December 20 expiration, right? So that means by December 20, again, I'm playing options here. I'm not really buying the shares. So when I get to OpEx December 20, at that point, a lot of my positions will be closed, and then I'll start to roll out to that third week in January, unless there is liquidity in between at some of the weeklies, which normally is not the case. So think about realistically, if we're buying calls and puts, which is what I do, and I know that I've got a timeline between now, November 10 to December 20. That's the third Friday of the month. That's our OpEx expiration. Now I ask myself, I have a chance to put on long positions, knowing they're going to have to be closed, sometime on or before December 20. And I'll see how much higher is high in those symbols with that expiration in places that are moving higher, like KRE, which, by the way, does absolutely benefit the Russell. And of course, if I'm looking at RTY, the IWM ETF is what would be in play, right? So I don't want to discourage anybody, right? But what I hope everyone realizes is there's trading entertainment and there's trading. watch television for trading entertainment. There's risk management and entries, and there's guessing at where a market's going to go. They're not the same thing. Our job is to focus on managing risk, finding an entry, and being realistic about the first target. So ultimately, if I am looking long in something like the S&P, the NASDAQ, the Dow, the Russell, yeah, all of them look pretty darn good. And as long as the cylinders of this motor, the sectors that belong to those indices are moving higher, the way KRE and Russell are moving higher, I'm bullish. I'll wait for a pullback, and then I'll see how high is high. Nobody knows where the markets are going, gang. Next time someone wants to give you an end-of-year target, tell them to give you the playoff scores as well. You know, one would be a ludicrous answer, but guess what? They both are. They both are. Now, there are ways to look at where resistance might be, take a look at volume, things like that, but nobody knows where the markets are going. I think the more we can just normalize, we play probabilities, the more we can actually start getting very profitable as traders. And ultimately, I've got 3 open positions right now. You can see where I'm making my bets. Strength in Cisco, strength in Wells Fargo. I love financials. I'd love to get XLF, XLI, and a few other outperformers like Amazon in the book, right? That's what we like to take a look at. All right, let's see what else we have here. Gold and silver. I don't play silver, Pete, but I do like the long side of gold. As far as the outlook, I want to get long on a dip, right? Do I like this as much as I would have liked this through September? No. So I'll probably be patient. Right now, Pete, I'll probably put gold on the back burner, okay? I definitely put gold on the back burner. All right, Norman's asking, am I expecting a pullback? Norman, it's the same answer I gave Sean. So guessing at where it's going is always going to be a guess. What I will say, let's look at it another way. Of course, it's going to pull back eventually. Nothing goes straight up, right? Eventually, but the main job we have is not, we're the batter in the game of baseball. We're at the plate and we're waiting. Got the bat in hand. We're ready to do what? Well, we don't know, because we don't know what the pitcher is going to throw at us. Are they going to try to sweep us off the plate? Are they going to throw strikes? Are they going to try to walk us? I don't know. The market is the pitcher in our game. We are the batter. So all I know, Norman, it's kind of the same answer with Sean. All I know is that there's going to be some kind of pitch thrown at us. It's my job to discern if that's a pitch that I can connect with. If not, I'll let it go by. And this we play a no strikes called game. I can watch a million pitches go by until I get the pitch that I know is high probability. So would I say the NASDAQ is eventually going to pull back? Sure. But let's not stay stuck on just the NASDAQ. Take a look at what's going on in some of the stronger sectors as well. That might be consumer discretionary. That could be keeping an eye on communications, keeping an eye on telecommunications, right? So yes, at some point we'll get a pullback. The main thing is, what are you defining as a pullback? Right now, I'm not looking at a mean reversion. What I am looking at near term would be my green candle sinking into Monday's volatility zone. And if it doesn't sink into Monday's volatility zone, I'll wait for Tuesday's volatility zone. I'll let that pitch go by. I'll let that pitch go by until I finally get that candle in that historical volatility zone where I'll buy calls, right? Because I know probabilistically when that happens, like it did on the 1st, like it did on the 8th, like it did on the 23rd, right? Green candle, gray zone. More often than not, if we can sink there, especially with an uptrend underway, which we don't have on the NASDAQ right now, even though we have higher highs, all-time highs, I'll still focus on green candle, gray zone, a bullish candle, bullish price, bullish participation in that support based on historical volatility, and then rinse and repeat. Okay. All right, gang. As always, thank you for being here for Charts and Coffee. Thank you for being here for Top Tier Outlook. I'll see you tomorrow for Charts and Coffee. And it's my hope that whether you agree with me or not, and look, gang, you don't have to agree. At least maybe it gets you asking another kind of question. And it gets you asking things like, what are the probabilistic things that I could play? Not the fortune telling crystal ball, where are things going? That again, no one can possibly answer, right? Nobody knows. But what we can say is we've got a trend. right? We've got a trend. And by the way, wasn't it the end of the world not but 2 weeks ago? Those were all wrong, weren't they? So what I'm saying is what's been working all year long, right, is find out what the general direction of the market is, wait for your pitch, and then focus on that. And that's what we'll continue to do. All right. Okay, gang, be good to each other. I'll see you tomorrow for Charts and Coffee. Thanks as always for the questions. I appreciate the time, and I definitely appreciate the questions. We just have to get a little bit more oriented to that nobody knows what's going to happen tomorrow. We just wait for the scenario that's set up that we know probabilistically works more often than not. And now, at that point, we're trading. Okay, be good to each other, gang.